Zoltan Pozsar's latest dire warning on the Fed, the economy, and financial markets. So let's have a look at this piece from Zoltan Pozsar, where he argues that the low inflation world that we've lived in for the last 40 years stood on three pillars. First, it was cheap immigrant labor, keeping service sector wages stagnant in the US and I'd argue across the West. Second was cheap goods from China, raising living standards amid stagnant wages. And third was cheap Russian gas powering German industry and the EU more broadly. US consumers were soaking up all the cheap stuff the world had to offer. The asset rich, benefiting from decades of QE, bought high-end stuff from Europe produced using cheap Russian gas, and lower income households bought all the cheap stuff coming from China. All this has worked for decades until nativism, protectionism, and geopolitics destabilized the low inflation world. And then came along President Trump's immigration policies, his protection tariffs, President Xi's zero cough policy, global supply chain issues, and then obviously President Putin and Nord Stream 2 and the gas problem heading Europe's way. He goes on and says that central bank, they've been saying for over a decade that their aim was to fight deflation by inflating asset prices, and all we had to do was borrow at low rates and buy assets irrespective of quality. Basically, the wealth effect. That's the Keynesian model, is the wealth effect. If we lower rates, do QE, and everyone borrows to buy assets, and those assets go up, we feel rich, so we'll borrow even more and lend against those inflated assets to consume. And that's pretty much been the West's economic model for a long time now. But that's not sustainable. It's almost like a Ponzi scheme. So now he says our jobs have become more difficult. Policymakers are no longer to follow are no longer central bankers, but heads of state at the pinnacle of power who aren't known for the transparency of their thinking, especially not when at war. Translating speeches from Russian and Chinese and catching high fives as opposed to fist pumps are becoming more important than parsing subtle grammatical nuances in central bank policy utterances. Central banks' policy objectives are changing. Central banks went from waging a war against deflationary impulses coming from the globalization, cheap resources, labor, goods, and commodities, to cleaning up the inflationary impulses coming from a complex economic war. He argues or says, think of the economic war as a fight between the consumer-driven West, so those of us with the Keynesian wealth effect, just borrow, feel like we're getting rich, to buy the products from the production-driven East. And there is that now conflict. So basically, he's arguing that this globalization has been disinflationary, I would argue. All the Keynesian economists say that, we haven't had high inflation because of globalization. Well, I've argued that globalization has peaked and we're now in deglobalization. So if they're right and globalization was disinflationary, then deglobalization, is inflationary. He goes on and says, by extension, Russia and China have been the main guarantors of macro peace, providing all the cheap stuff that was the source of deflation fears in the West, which in turn gave central banks a license for years of money printing, QE. His words, not mine. He used the words money printing. Now, he says central banks are done with fighting deflation with asset price inflation and are now fighting inflation with asset price deflation. So basically, it's the reverse wealth effect. This is their policy. This is where they're going now. Towards the bottom of this page, he says, if we're right that the economic war is the right context to understand inflation, then Western central banks will not have any good options to slay inflation. They can surely reduce demand by raising rates, but what if supply curves shift inward faster than demand curves. The market doesn't think much about that. Wars are hard to forecast. So inflation is the expansion of the currency supply, the credit or currency supply. Prices are a different thing. So the monetarists believe that it's just the expansion of the currency supply and leave it be. Now, I've done videos on inflation, what is inflation, and Austrians say that the monetarists only have one side of the equation, that you actually have to look at the demand for that new currency, i.e. the supply of goods that it's chasing. And I've argued before that, using simple figures, that if you had one banana at $1, all of a sudden you increase the currency supply to $10, but you still got that one banana. What's that banana worth? However, if you increased the supply of those bananas to $10, well, what's each banana worth? What if you increase supply to 20 bananas and had $10? What are the bananas worth? So you need to look at both sides of the equation. And this is what he's saying here is, what if we reduce demand by raising rates, causing a recession? But so basically we've got this problem. Yes, people argue we've got supply chain issues and that's what is driving the inflation. Well, that's what's driving prices. We've had inflation. We've had a reduction of supply. And this is why it was one of my easiest calls in my career to call inflation. That would have higher CPI. You create new currency. At the same time, you lock down economies. You destroy production. You destroy supply. That means there's going to be more currency chase and less goods and services. Pretty simple to me. Anyway, so we've got less supply. Yeah. What if we reduce demand, but supply drops even further? You ain't gonna reduce CPI. So, you got to think about that. So I'll put a link in the description to videos where I've explained inflation. They're the Austrian definition of inflation. And so I'll put a link in the description below if you want to understand more about what I was just talking about. So this was an interesting part of his piece. Getting right where inflation goes from here is basically a matter of perspective. Do you see inflation as cyclical? So a lot of people argue transitory and whatnot. They say it's cyclical. Or is it structural? If the former, inflation has peaked. If the latter, inflation has barely started and could actually be understood as an outright instrument of war. For as Lenin said, the best way to destabilize the capitalist system is to debauch the currency. Then he goes on and talks about some of these macro investors like George Soros, Stan Druckenmiller, Paul Tudor Jones, etc. Were very successful, but traded mostly in a peaceful world, punctuated only by relatively small military conflicts, where now we're most likely moving into a complex economic war. Whether that involves shooting or whatnot, well, time will tell. And then he just talks about John Maynard Keynes and Nathan Rothschild, who loaded up on gilts when he learned before everyone else of Wellington's victory over Napoleon at the Battle of Waterloo. And so he's just talking about, we are entering a different game that none of us have ever seen. And right down the bottom, he just says, in the context of war and interest rates, the focus of today's dispatch is inflation and the Fed. In subsequent dispatches, we'll talk about what it will take to fix the supply side issues of the West, why Bretton Woods 3 is the East's natural response to the West's supply side fixes, and why central banks won't be able to get out of QE, no QT, even as inflation is likely to remain high. All right, so he talks about the extreme tight labour market here. After decades of neglect, food and energy prices can't be stripped out to focus only on core inflation. Food and energy prices and basic everyday necessities are especially dangerous in a structurally tight labour market. Wages are under pressure already globally because of cost of living issues. Government workers in Australia recently got a 5% increase in their salaries, and we also passed a increase to the minimum wage of 5.2%. And then there's a whole heap of other countries that are also seeing that as well. Comments from corporate CEOs during the second quarter earnings season also suggests that price pressures will continue for the foreseeable future globally, and that means that other than food, energy, and core services inflation driven by wages, core goods inflation will remain a problem too, driven mostly by supply chain issues due to President Xi's zero-COVID policies. He says inflation today is simply everywhere. It's plain impossible to talk to anyone who doesn't complain about rising prices or to read the financial press without articles about inflation. It's also impossible to have a client meeting where inflation is not the center of discussion. As James Aiken recently noted, inflation expectations are well anchored when nobody talks about inflation. Now, some market participants like to see the silver lining in today's environment, arguing that energy prices today aren't as big a deal as they were in the 1970s because a service-intensive economy is less energy-intensive. Zoltan says that's nonsense. What oil is to an industrial economy, people are to a service economy. When Bill Dudley says that in his 40-year career in finance, he hasn't seen a labour market this tight, I assume he means that the service economy is having its OPEC moment. I can't have a client meeting without someone asking me where all the workers have gone. I have no idea. They have apparently gone. Now, Joseph Wang and others argue that because of the wealth effect, because so many people have made so much in financial markets, that they've quit their jobs. They've left the employment market, and they ain't coming back. People have taken early retirement. Others argue that a lot of people lost their jobs due to mandates, and they haven't got their jobs back. That people have now moved out of the cities and are living a very different lifestyle. Maybe it's a bit of all of the above. Zoltan says, but perhaps the most unsettling parallels to the 1970s and early 80s is the Fed's and the market's assumption that all it will take to break inflation is hiking interest rates with the resolve and determination of Chair Paul Volcker. Paul Volcker is no doubt responsible for the deep recession of the early 80s, but we shouldn't assume that rate hikes and a recession are all that needed to weed inflation from the system. Recessions can help, but may not be enough, especially if Ray Dalio and Larry Fink are right, and we're headed for stagflation, i.e. an environment where inflation is persistent, whether there is growth or not. Now, I've argued about a 1973-74 style event where we have a deep recession where asset prices fall 50% in nominal terms, while CPI remains elevated. In fact, that's still my base case. That's where I'm leading. So, yeah, I would not like to be in debt-based asset classes right now. So asset classes that have been pushed up due to an expansion of debt. Now, towards the bottom, he says today's environment couldn't be more different. First, unlike the 70s when oil majors had invested for a decade to pump more, we just ended a decade of little investment in oil fields, a legacy of ESG policies. I've been talking about this a lot on this channel. Yes, the price of crude is falling due to recession fears, but it is not collapsing. Supply in the oil market is tight, and releases from the SPR won't last forever. Whereas in the 1970s, we invested in oil. Today, we're depleting oil reserves, and it takes many years to develop new fields. The oil market will get tighter during the Fed's current tightening campaign, not easier like under Volcker. And right down the bottom, but today we have a bigger problem, a shortage of labour, particularly in services, which is due to a mix of factors such as tougher immigration policies to appease nativists, early retirements, as I mentioned, and other labour market changes driven by the, which I also mentioned, and extreme wealth gains, as I said. So given today's inflation backdrop and the similarities and differences between the 70s and now, let's talk about the Fed's tightening campaign to slow inflation. I chose the word campaign carefully, as I think that it is fundamentally wrong to refer to what the Fed is currently doing as a tightening cycle. That's because a tightening cycle is something that corresponds to a business cycle, and business cycles are about central banks managing short-term misalignments between supply and demand. But our opening essay was making the point that what we are living through now is structural, and so we are not dealing with a business cycle, but rather with something straight from the book of Genesis, i.e. a 7 fat years followed by a 7 lean years type of thing. And once again, talks about this, reducing demand to try to get it somewhere around supply. He says the Fed went from generating demand structurally to soak up an excess supply of cheap stuff to curbing demand structurally to adjust to shortages. That's called right sizing or belt tightening, which are structural, not cyclical affairs. It follows what the Fed is currently engaged in isn't a hiking cycle, but a structural tightening campaign. So what he's arguing is instead of playing catch up with the pre-GFC trend of aggregate incomes, we're now playing catch down to the post-nativist, post again, trend of aggregate supply. So basically bringing demand down to supply. And that means a lot of pain. The level of economic activity needs to adjust down in an L-shaped manner. If it doesn't, we'll have more inflation problems. In this context, the market's no recession soul searching is ridiculous. The inward shift of supply curves across multiple fronts, labor, goods, and commodities, is the main driver of today's inflation. If demand needs to be curbed significantly to slow inflation, and if a substantial reduction of aggregate demand means an L-shaped path for the economy, why is it so bloody hard to see that we need a recession to curb inflation? And Zoltan says that involves not only slowing the interest rate sensitive parts of the economy, housing and durables, but also reducing demand for labor in the services sector. It is a function of the level of wealth across a range of assets, housing, stocks, as well as crypto, to weed the feel rich, spend more, and feel rich, work less mentality from the system. So the wealth effect, that's what they've done. And mate, us Austrians could have told you that a long time ago. So halfway down here, the market can talk all it wants about a soft landing, but as explained, we need an L-shaped adjustment in activity, and an L shape has two parts. First, the vertical drop, perhaps a deep recession. Second, a flat line, which you can think of as stagnation or stagflation. So right down the bottom, he says Bill Dudley and Larry Summers are having a Volcker moment in a spot sense, but they're not in charge and they don't have to navigate the political aspects of interest rate hikes. Jay Powell has to, and that is why he's moving slower. But moving he is, and he is quietly having his Volcker moment in a rolling forward sense. Look at the pattern above. Listen to him when he says that there will be pain. Listen to him when he says we'll cut when inflation is dead. We are paraphrasing Powell only on the last bit, but are not exaggerating. This is not the growth-sensitive Fed of the post-GFC era. This is not the stock-sensitive Fed of the post-Greenspan era. This is not the unipolar world order the Fed has been operating in since World War II. This is a different ballgame. And if you think that the peak of tightening is 3.5% because inflation peaked, and that cuts are coming next year because a recession is high and stocks are now at the cusp of a bear market, you might be terribly wrong. Bill Dudley and Larry Summers are right about the direction of travel, but Jay Powell sets the pace because he is accountable to Congress. Dudley and Summers are not. But make no mistake about it, the risk of the Fed hiking to 5 or 6% is very real. There you go. He's saying 5 to 6% is very real. And ditto, the risk of rates cresting there despite economic asset pain. The market and the Fed's SEP is telling us that we will curb the biggest outbreak of inflation in 50 years with a hiking cycle, where the peak of the hiking cycle next year corresponds to negative real interest rates, unless you think that inflation moderates to target, that is 2% by next year. That is true. I'm going to retake Economics 101. What could I be missing? Is Jay Powell a dark horse who's more political than serious about inflation? I do not think so. Once you go down the path of invoking Paul Volcker's legacy, you can't avoid making good on that promise. If you do, you damage the Fed's reputation irreparably. The risks are such that Powell will try his very best to curb inflation, even at the cost of a depression. There you go. He said depression. And that's what I say. If we go to 5 or 6% on the overnight cash rate, where mortgage rates are going to go, where business rates are going to go, depression is most likely on the cards. So this is what Zoltan's saying. Powell will try his very best to curb inflation, even at the cost of a depression and not getting reappointed. Between a deep recession damaging the Fed's reputation as an institution, a deep recession is the lesser of the two evils. The former is public service, the latter is public disservice. The former is a central banker's clear conscience, and the latter is a lifelong burden. Whether J. Powell will succeed in slaying inflation is not the question. In the context of economic war, we can doubt that. Rather, the question is whether he'll try his best to slay it. There, I have no doubts. In our next dispatch, we'll start thinking about what's next. If we are right about the nature of inflation and the need for an L-shaped path for the economy, how will we ever ramp up the bottom part, the stagnation part of the L without generating inflation? If the East holds the key to the West's supply and economic war means the supply side is held back, West will have to develop its own supply of things such that L becomes, well, not quite a V. And much like its current hiking cycle is not a cycle but a tightening campaign, that recovery won't be a recovery driven by rate cuts but by fiscally funded industrial policy, which we'll discuss in detail in our next dispatch. Okay, so there you have it. There's things that I agree with Zoltan Pozsar on. There's things that I disagree with. So he wants the Fed to raise rates to bring demand down to supply through fiscally funded industrial policy. I don't believe that's the way. I believe that governments should get out of the way, reduce regulation, free up business, free the entrepreneurial spirit, and allow investors to come in and create more supply, create entrepreneurs and businesses to create more supply to get supply up to demand. We'll have a growing economy then without the inflation, without the CPI, without the devaluation of currency. But no, they just look at this side of things. So, you know, I've been banging on this channel for some time that I think we're in an inflationary decade ahead, and certainly Zoltan thinks that as well due to many factors. The energy side, I'm glad he brought that up. I've shared charts going back 50 years showing oil and CPI, so you guys know about that. Just I agree with him. I don't think this is cyclical. This is more structural to me. Imposed a lot by governments. This is a lot of it is government doing with policies, whether it's on energy or you know just stifling the economy and regulating the heck out of it and trying to you know, they want to be these central planners. So whether it's government or central banks, they just love this idea of control and central planning, which has never worked. It has never worked. And the other thing is, I do believe globalization has peaked and we're going into this trend of deglobalization. And that always gets a bit nasty. So hopefully, you know, we don't have bad wars like we have. But to show you guys this globalization, deglobalization, I just want to cut to a short clip with George Gemin, who has this awesome little chart. And in fact, I highly recommend you guys watch the whole video. It's only an 11, 12-minute video based on what Zoltan is talking about. And if you're not subscribed to his channel, do so.
Now let's move over to this chart and put all the pieces of the puzzle together. We start 1870 and go all the way to today's date, and we try to think about what may happen into the future going all the way out to 2038. So this is a chart of globalization and deglobalization. It actually runs in cycles. I found this fascinating when I was doing the research. On the left, we go from 0% up to 60%. These percentages are basically a proxy for globalization. So going back to 1870 all the way to the beginning, roughly, of World War I, we saw globalization increase. Countries were sending more goods and services back and forth due to the Industrial Revolution. Then we get World War I, and it just plummets, as you would imagine. And it goes down throughout the Great Depression until the end of World War II. So this time frame, this cycle, if you will, was about 30 years, roughly, maybe 31, 32 years. And what we saw is kind of a feedback loop, a doom vortex, if you will, where protectionism and tariffs led to less economic growth, which led to even more protectionism and tariffs. And it was this downward spiral until we get to a point where globally we have social unrest. If you get enough social unrest, what does that lead to? 9 times out of 10, it leads to war, which is exactly what we saw at the end of the last fourth turning, or the end of this deglobalization cycle. But then we go into a phase of globalization once again, from the end of World War II all the way to the GFC. Once we get to the GFC, we have less economic activity. This creates an environment of a little more protectionism, but the protectionism goes into overdrive when Trump gets elected in 2016 or so. But what Zoltan is saying is now what's happening because of the cerveza sickness, Russia, Ukraine, China, Saudi Arabia, India, the BRIC countries, etc. We're seeing this deterioration, this breakdown, this structural problem where the relationship between the consumer-driven West, the demand, global demand, let's say, and the global supply with the East for all the goods that we consume is breaking down significantly. This would lead to a collapse in the goods available in a consumer-driven economy such as the United States.
So you guys know I've been banging on about this for some time. With this video, warning markets will crash 50%. I've been warning that central banks are going to raise rates. I sent an email out to our clients late last year warning that the bond market was telling us rates were going up and that they should lock in at 1.89, 1.99. Well, now some 5-year fixed rates are over 7% now. And a lot of our clients ignored us. But we saw this coming. Everything bubble collapse, including silver. Talking about, Kyle Bass was sharing similar themes that there's a lot of liquidity to be drawn out of the markets as interest rates rise, and that impacts people's borrowing capacity. Warning, the everything bubble is over. Property crash 25% this year. Once again, as interest rates rise, that impacts people's borrowing capacity. And, I shared an example with a client that did lock in at 1.99 and their borrowing capacity was $1,060,000. However, at 5.99, the borrowing capacity is $640,000. So it doesn't matter whether someone wants to sell a property at $1 million. Her maximum borrowing capacity is $640,000. She ain't buying it. And that goes for a lot of people in the market. And this was one of the first videos that I did earlier this year, Don't Fight the Fed, where I shared my political background and why inflation has, at that point, had become a political issue. And I believe that the Fed would raise rates, that central banks would raise rates and raise rates higher than we expected. Do I think that they will raise rates to 5 to 6% like Zoltan is saying? Well, if they do, then we're going to get a extremely deep recession, probably a depression. He says they're going to leave them there for some time. Gee, I don't know. I mean, we're going to see financial institutions and banks collapse. Do they want that? I don't see that happening. I don't see that happening. But anyway, guys, what do you guys think? Do you think Zoltan's on the money? Do you disagree with some of the things he's got to say? I'll tell you what, if he's right, what I do agree with is inflation is now structural, or CPI is structural. We're going to have high CPI, high debasement of currencies, at least for this decade ahead. And that's why you want to invest, in my opinion, for an inflationary environment, a stagflationary environment, an environment where, yes, we can see asset prices which are being pushed by debt. So be careful of those assets. Basically, what I'm saying is financial assets, real estate, etc., and you want real assets which haven't been pushed up by debt. So I still see a 1973-74 style event. And what I mean by that is simply that asset prices will fall as interest rates rise, yet it won't do nothing about CPI. CPI will be elevated. So that's what I'm saying. When I talk about 73-74, that's what I'm saying. I believe that asset prices will tumble and CPI will remain elevated. Anyway, love to see what you guys have to say. Leave your comments below. I'll put a link in the description to these videos. I'll put a link in the description to George Gemmen's video. Watch it. Sign up to his channel if you haven't already. And I'll also put a link to my video where I discuss inflation. What is inflation? Because a lot of people get confused about that. Anyway, guys, if you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.